What's going on, everybody? My name is Chase Lawson. This is the Financial Freedom Show where I make personal finance simple. Thanks so much for tuning in. So let's get started with another episode. So if you're tuning in, you're probably trying to find ways to get your credit score up higher. The reason why this is so important is because your credit score ultimately determines if you can be approved for things like credit cards, loans, or mortgages. And the higher your credit score, the better position you'll be in, as you'll be more likely to be approved for credit and often at much more favorable terms, such as a lower interest rate. Makes sense, right? Well, when looking at your credit score, the most common model is your FICO Score, which ranges from 300 to 850. Anything 740 and above is considered either very good or exceptional, but if you're not currently there, it shouldn't take long to get there, and hopefully when you finish watching this, you'll learn some things to implement to quickly improve your score. So there are 5 different weighting categories when it comes to your credit score. The largest factor, accounting for 35%, is your payment history, or how reliable you are in paying your bills on time. For this, the credit bureaus only care if you pay the minimum balance due each month on any credit balances you have. So if you owe $2,000 on a credit card, but the minimum payment each month is only $35, as long as you pay at least $35 each month by the due date, you're covered for this category. One 30-day late payment may lead to a small ding in your credit score, but if you have multiple late payments or late payments that extend beyond a month, your score will likely suffer even further. Show you can pay your debts reliably and pay at least the minimum amount due each month on all of your balances. The next biggest factor, which accounts for 30%, is your credit utilization. Credit utilization is the percentage of available credit that has been borrowed. For example, if you have a credit limit on a credit card of $10,000 and your outstanding balance is $7,000, your credit utilization is 70% on that card. Credit rating agencies don't like to see high balances on accounts, so if you're always running up high balances on accounts, try to spread this across other cards. A good credit utilization rate is 30% or less. So this is both on individual accounts and across all of your accounts combined, so make sure you manage your spending appropriately and try to pay down those higher balances before your statement cutoff date. So those first 2 factors alone are almost 2/3 of your credit score. The next 15% is length of credit history. So the longer that you've maintained your credit, the better you'll be perceived in this category. If you just started maintaining credit accounts, such as if you just opened your first credit card, you will be perceived as risky. There's not a whole lot you can do about this. However, once you do open accounts, leave them open, as the longer time passes, the less risky you'll be perceived. This factor is viewed both on your credit history in total, as well as across your individual accounts as well. So don't get into a habit of opening a lot of new credit accounts, as this will weigh your score down. The next 10% is your credit mix, or the variety of different debt products you utilize. For this, essentially, they're looking for you to be well balanced when it comes to credit. If you have credit cards, student loans, a car loan, and a mortgage, these are different types of debt products. Once again, there's not a whole lot you can do here, and you certainly shouldn't open up an account just to open up an account. But if you do need it, it will certainly help your score. But once again, this is only 10%, so a pretty minor amount. Finally, the last 10% is new credit. If you just recently opened a lot of accounts, your score will drop. So once again, do not get into a habit of opening a lot of credit accounts, as your credit history will suffer, as will this new credit category. However, you may need things like a mortgage or to finance a car, so whenever you do need one of these debt products and you want to comparison shop, do all of that rate shopping within a few weeks of each other, as the credit bureaus view that as a single inquiry when calculating your credit score. So obviously, as you can see, the easiest thing to do is just give it time. Your score will increase as you let your accounts age. Don't open new accounts unless you need them. Pay at least the minimum payment each month, but ideally pay all of your balances in full so that you don't incur interest charges and so that you keep your credit utilization low. Always pay on time. Whenever you do get your credit pulled, do so all at once by all the potential lenders you're speaking with. And if you can avoid changing your current spending habits, feel free to ask for credit limit increases on some of your accounts to also help with your credit utilization. There you go. It's pretty simple when it comes down to it. As I've mentioned before, I managed to turn my credit score around from the low 500s when I had over $23,000 in credit card debt to the high 700s within 11 months after paying that balance off in full. So you can do it just as well. Leave a comment below and let me know what questions you have or what else you want me to cover. And as always, please subscribe, hit that notification bell, and smash that thumbs up as well. Thanks so much. Stay safe and go get them.